and
Okay,
some
perfect.
stuff to go through too. So
yeah, I just kind of told people that it would be, they could ask questions, and I'll just let you handle it.
great.
We can just get going now if you want, since it's 12. For everybody that is on, this is Trent. He is my personal CPA, and like I said in the team meeting, he's amazing.
Yep, that's fine.
And Trent, are you cool if I record this so I can share it with people that don't make it?
Yeah, happy to.
Okay. All right, well, I will let you take it away, and I will make you co-host so you can share your screen if you end up needing to.
Okay, sounds good. Well, we could probably start. I just have a quick PowerPoint that's real estate agent focused. So
awesome.
it could potentially answer some questions that people may have, and then I should be able to through it pretty quickly. And then if we have questions at the end, just shoot away, and I'm happy to help.
Cool.
So let me do that screen share.
And I'll kind of watch the chat box to see if people post anything in there too.
Great. Alrighty, so for those who don't know me, I'm a Washington CPA and owner and a partner of Trail CPA. So located here in downtown Kirkland. Have a bit of a niche being formed in the real estate space, real investors, real estate agents, mortgage brokers. So we're representing a lot of people in that space, and we're starting to specialize in that area as well. So anyway, just the title of it, this is Tax Tips, Real Estate Agent and Client Focused Strategies for you guys. So let me move to the next one here. So just a little bit of background on me. So since, of course, I know Lena and maybe a couple other people that are going to jump on the call, but quick background on myself. Love accounting. Accounting is my favorite. So it's pretty rare out there that you're going to find a lot of people these days that really love it, but I do. 12 years in accounting, mixed of public and private roles. Mentioned Washington CPA, master's in accountancy. Actually, yesterday, if I'm correct, was the 2-year anniversary of Trail CPA and jumping and starting my own practice. So always something that I wanted to do, and was just building up towards doing that over time, and felt comfortable to make that jump 2 years ago yesterday. Crazy.
Awesome.
I didn't even celebrate. I celebrated with tax returns. So fun is that. So this was something just kind of more current events, just, what's going on with tax changes with COVID-19. I would say a few of the big ones, of course, is stimulus. So people who didn't get their stimulus payments, you can claim those credits on your tax return. So something I'm helping my clients with, and actually helped somebody this morning with. Deferring payroll tax has been another one, pushing that out and paying that payroll tax later in time. Net operating loss carryback is a big one. So businesses that lost money. So maybe some of your real estate investors, maybe they didn't do so well last year because they didn't get rent payments. Well, there's ways to take that now with the CARES Act, to take those losses and then offset gains that they previously had and get a big refund check. So helping out a few clients with that. Those are some of the big ones when it comes to CARES Act. It's a long one, but those would be my bullet points from there. Pyramid of tax planning. So this is just our philosophy here, just a base of organization. So making sure that our clients are organized throughout the year. They know what's coming. There's no surprises. Making sure that they're tracking their expenses and their income through a business bank account, perhaps an accounting software. We'll talk about that in a little bit. Staying compliant. So a lot of our clients are moving from W-2 over to 1099. Maybe they're a new real estate agent or have been for a little bit, and maybe they're just not sure what they don't know. So just making sure they're compliant with the state, making sure they're compliant with the federal government. And we'll talk about structure in a little bit later in the slides. And then finally, strategy and planning, which I think for me is the most fun part. What are ways that we can legally use tax code to pay less than you would have otherwise? And we'll go into each one of those, but just of course deductions. What can we write off? What can we offset your income with as a real estate agent? What tax structure is the most appropriate for you? Are you taking advantage of some of the retirement options that are out there for 1099 non-statutories like yourselves, among other strategies? And we talked about a couple credits with CARES Act and just staying on top of new tax law and how we can use that to benefit our clients. Organization. So simply, this sounds like some one-on-one stuff for some people. You'd be surprised on how many people are coming into our office with, the shoebox of receipts or a big folder of receipts. There's so many easier ways to stay organized than just saving receipts and throwing them in a bag. And so setting up a business account after you set up an LLC, it's really easy. Just having some discipline of using that card when you're out, either showing a house or taking a client out to lunch or getting a coffee. And then also, those questions, Trent, does this sound like something I should run through my card? I love when clients ask that. We'll help you navigate any of those questions and let you know what you can and can't deduct. So if we have questions at the end about certain things, let me know. Accounting software. So for real estate agents, maybe accounting software might not be necessary. It just kind of depends on where you're at in the stage of the business, but it's a great way to know where you're at any given time. Being able to pull a P&L out of QuickBooks is helpful. And of course, knowing, I'm sure a lot of people are using bank balance accounting and looking at their bank balance to try to figure out how well their business is doing. It can be a little bit more complex than that. And with accounting softwares now, about how automated they are and how the bookkeeping can really be done with minimal effort. We help a lot of our clients get that set up. And so that's really running on autopilot in the background. And then you'll be able to pull financials at any given time. Take a look at your P&L, take a look at your balance sheet. And not only for your business, but you can do it for your personal as well. Some clients have that so they can know their net worth and how it's tracking. Receipts and records. So making sure that you're holding on to your receipts and storing them. That's not something that I'm tick and tying through a tax return, unless I'm doing some light audit on a business return, but something you want to hold on to. Really, the IRS can audit you at any time, even though they say 7 years and 3 years. It's really any time. So I would hold on to those receipts. A good thing what I do is I try to do everything digital. So I'm taking a picture of my receipts. I upload it to Dropbox and it's simply in a folder, 2020 receipts. I'm not going too much deeper into organizing things into different buckets and too much time there, just because the chances of an audit are pretty minimal. But having them, if you were to go through an audit, is just priceless, because the IRS can disallow those expenses and it'll be really costly. Especially in the real estate world where, meals can be relatively higher than other businesses. Mileage is a lot higher than other businesses. So that can get red flagged by the IRS pretty easily, even though, it's really fair to justify those expenses. But I would just say in the industry that everyone's in this room, it's just something to be aware of. So when you do get a meal with somebody, who was it? Write it on the receipt. I met with my client Mary before a showing, or maybe I bought something for a showing. These are ways to stay organized, which is the theme of this slide, and to just be a little preemptive, just in the case if you did get audited, and then it really takes the scare away from being audited if you are prepared. And it's a pretty simple process if you have all your ducks in a row. So compliance, I'll buzz through this one a little bit quicker, but federal filings. So of course, making sure that your tax return is filed. You don't want to get behind on that. Making sure you're filing your 1099s if you have to. So if you have vendors, maybe someone who's doing staging for you, for example, if you're paying them over $600, then you're going to want to send them a 1099. I can help coach, I help coach my clients on, who really needs a 1099. It does depend on how you pay them. So, and then what type of entity they are as well. So shooting out W-9s to your vendors is always good practice if you know you're going to pay them over $600. Estimated payments. So in this industry where you're likely going to have a tax bill at the end of the year because you're not having withholding coming out of your checks, Once that happens, then estimated payments are going to come into play for the next year. So just making sure you're on top of estimated payments, making those payments, and then just knowing that that's withholding and prepayment for tax for next year. So staying on top of that. State filings. So state of Washington, excise taxes, knowing what frequency, what amount, where to pay, getting set up with an account, having a business license. This is all compliance related. So something to keep in mind there. Might spur some questions. One area on strategy and planning is entity structure. So you may have heard of an S Corp, C Corp, sole prop, LLC, a bunch of different options for entity structure. Now, this really comes into play when you have 1099 income or you're running a business. This is nothing to worry about when you're in W-2. And so just talking about which of these entities is most appropriate for where you're at. And so I typically recommend starting as an LLC. Sole prop is going to use your social security number. I would say a few benefits of moving from sole prop to LLC. One is, well, your social security number is not going to be floating around. You'll get an EIN that's going to be tagged to your LLC, and then you can send that out to whomever is requesting it. Also, just limited liability protection. When you have an LLC, it's really just the assets within that LLC that are going to be more at risk. And of course, there's some exceptions to that, but for the most part, the taxation though is the same for a sole prop and an LLC. They're both going to be a Schedule C on your 1040, and so not too much difference in taxation there. This is more just a legal update for you. We'll go down to S Corp. So S Corp, really how an S Corp and a fair amount of real estate agents are in the S Corp structure. But the idea behind the S Corp is to help mitigate self-employment tax. So I'm sure a lot of you agents are familiar with the self-employment tax and 15.3%. That's on top of your normal federal income tax. It's pretty heavy. And so S Corp is a way to help mitigate that once you're making over a reasonable wage for your industry and your geography in the space. So this is an analysis that I help a lot of my clients through. Now, I will warn, there are some hoops to jump with an S Corp. I would recommend getting in an accounting software like QuickBooks, because a balance sheet is going to be needed to be reported. Having to do that outside of an accounting software is a bit of a chore. Also, other requirements such as only one class of stock. You can only have a certain number of members. You have to pay yourself a W-2 wage, so you have to set up payroll. There's another tax return that you have to file. And so it's not as easy as an LLC, but if the tax savings justify those additional hoops you got to jump, then you're going to want to do it. Just a quick example is, if a reasonable salary is $70,000 in your area and you made $100,000 in profit for the past year, the math is going to be that $30,000 delta times that 15.3% would be your savings. So just some quick math in my head, that's about $4,500 in tax savings. So that's $4,500 you would not be paying to the IRS and that you would keep in your pocket from simply just one tax structure change. And then of course following all the other rules of paying yourself a W-2 and making sure that you're having some really solid accounting happening as well. And then finally, C Corp. C Corp would be pretty rare for an individual agent, but some of the bigger groups will decide to go that route. Corporate tax rates dropped to 21% from 35% back in 2018, so became a little bit more attractive. But there is a 15% dividend tax that's coming out when you do pull money out. So an effective rate of 36% on a C Corp still, even with the tax reduction, is still pretty high. Much higher than it would over in an S Corp structure. So anyway, that analysis can be done. But C Corp, if you companies that want to go public or bring on some more investors, a C Corp can start to make some sense over there. And there's some others as well, but I would say LLC and S Corp are by far the most common. Tax deductions, so just things to keep in mind. I mean, this is just a few of many. Vehicle costs is a big one. So agents are going to be using their car a lot. Does it make more sense to itemize the vehicle costs or use the mileage deduction? Again, an analysis I'll do with clients to make sure they're taking advantage of the most deductions they can. So typically we'll itemize a vehicle when the vehicle is fairly expensive. That means we can really get a pretty large depreciation on that vehicle. And then we'll also take gas, we'll take repairs, we'll take any other costs that are going on with the vehicle. When you use the mileage method, typically that is more lucrative when you have vehicles that aren't as expensive. So just something you're going to want to look into to see if itemizing or using mileage is going to be a better method for you. Home office deduction. So sure, agents have always had home offices, but especially now, home offices in COVID. So something else, I have templates for that. So if anybody's interested in a home office deduction template, I have a PDF that's fillable. It's pretty easy to use. Meals and entertainment. So just tracking those and making sure you're running those through the account and you're documenting what's happening. Gifts, knowing what the limits are on gifts, $25 is deductible per person. So there's a couple, you could give a $50 gift for someone who closed the place and you'd be able to write off that $50 of expense. Uniforms, knowing what, it's typically a logo and it should be used just for business only. So you can't be buying clothes that are, multi-purpose, so business only. And then also heavy vehicle bonus depreciation. So a lot of agents are, the agents that are doing well in this area, which, there's been quite a boom in real estate. I'm, probably stepping over my bounds with talking, even I know you all know more than I do about this, but, there's given how much real estate agents are making in the area, a big deduction like a heavy vehicle bonus depreciation can start making sense. And so vehicles over 6,000 pounds, this is really more geared in my mind by the IRS to stimulate, businesses that use big trucks or vans or more industrial type businesses. But that said, some of the vehicles that qualify are, big, like a Chevy Tahoe or some of the other business vehicles that you could accelerate depreciation forward, take 100% in the first year, and then be able to write off a lot of income. So for example, you made $100,000 and this vehicle is $50,000, you'd be able to take that $50,000 deduction right away. So it makes, buying a new vehicle a little bit more affordable, knowing that you're going to be able to get that deduction first year and you're going to be able to write off $50,000 of income, especially if you're paying self-employment tax. I mean, that can be a 35, 40% reduction and actually cash out the door by buying a vehicle that qualifies. So to the next one. Oh yeah, I didn't even see the photo. So retirement too. So this is also something that when you're moving over to 1099 is, not as easy when you're on W-2. It's pretty simple when you're W-2 and you just fill out a form, but knowing what retirement options are available are just more good ways to bring your taxable income down. So what's most appropriate is a solo 401k, which you can max out at $56,000 per year. Is that the way to go? Maybe. Is a SEP the way to go? Or maybe just your IRA or a Roth IRA. Those are all good options that we can help talk you through what we recommend for retirement. So something to keep in mind, and also is just a perk of being paid in 1099 where you'd be capped at $19,500 as a W-2. Now, why not take advantage of higher limits on retirement, given that you're okay with cash flow and moving that money into something that would be captive until you're at retirement age. So. Yeah, so I could probably talk all day about this slide, but why investing in real estate is a nice tax break. So this is really just more for your investor clients. And the ones who are more sophisticated, have multiple properties, I'm sure are very aware of this, given how much attention and time that they spend in the area. But maybe someone who's a little more novice coming in that's looking to buy their first rental property or their second rental property, things to keep in mind. Real estate, at least in Washington, is typically a pretty nice tax break on passive losses that are coming through. And that's really purely because of depreciation, and then also just the ratio between what they're cash flowing versus what their costs are, even just on the mortgage and property tax. So just something to think about. Also just depreciation recapture. I've had several clients that have not been aware of this when they sell their property. This is that depreciation that's coming back at a maximum of 25% on the way back. So if you've depreciated a fair amount and then you've also had this gain of the property, then not only capital gains, but also depreciation recapture, is going to be pulling a significant amount of that cash out. And so something to be aware about, and, maybe someone would hold on to the property or decide to, do something else with it if they knew about this. Active investors. So, people who are spending a significant amount of time in the space of real estate are actually able to use active loss or active gain to offset active loss or gain on the other side of maybe their W-2 jobs or other things they're doing. If they're not spending a significant amount of time, it's all in the passive category. So passive losses can only offset passive gains, and vice versa, active gains and active losses. So it can be a lot more valuable to have that active status. Cost segregations, so just different ways to accelerate depreciation on properties. 1031s, so I'm sure you're familiar there about being able to defer capital gains. And then opportunity zones, just another tax strategy with opportunity zones of deferring capital gains and actually eliminating capital gains on certain properties. And so being able to move properties into these zones is, the state, of course, wants to accelerate growth in these areas, but it can be a really interesting tax play. So if you have an investor client that's really worried about capital gains, that might be something to bring up to say, hey, maybe you look into, into opportunity zones or maybe even a 1031, and that'd be a good referral over my way as well. And then just for homeowner clients, so of course, mortgage interest deduction, recently capped at $750,000 of principal, $1 million if it was originated before 2016. Property tax, of course, is deductible on your Schedule A. Capital gain exclusions for primary residences, so $250,000 for single filers, $500,000 for married filing jointly. Just some things to keep in mind for your homeowner clients here. And I think I'm at the end. So if you want to jump over to Q&A, Lena, I can stop the share here.
Pretty much anybody can just jump in as they want if they have questions. Maureen said, what is 199A?
Yeah, that's a good question. So 199A is also known as qualified business income deduction. And so that was added with the Trump tax changes in 2018. So I did mention that the corporate rates went from 35 to 21. Now 1099A was the benefit for pass-through entities. So this is your LLCs and this is your S corps and sole props. So you'll be able to get a 20% deduction based off your net profit for the year using 199A. So another example, I'll use the $100,000 of profit. You get a $20,000 deduction right off the bat. So your taxable income would go from 100 to 80 using 199A, the qualified business income deduction. And so a bunch of rules around this one. There's some phase outs that happen for specialized services, trades, or businesses. So we're helping our clients navigate that, but you would be having to make a pretty significant amount of money before the QBI is phased out. So yeah, hope that answers your question. But if you, as a real estate agent, you'd definitely be eligible for 199A, and is a huge benefit. So you want to make sure that that's on your return.
Who else? I know you guys have questions just boiling in your brains.
I have a question. I came a little bit late to this because I had an appointment, so I'm sorry if you already answered this, but I would just like some clarification on the difference between like a tax deduction and a tax credit and a tax write-off. I'm brand new, so I'm just trying to figure all this out.
Yeah, you got it. So so a tax deduction and a write-off are really one and the same. And so when someone says, oh, I'm going to write off my desk, my office desk, well, that'll be a deduction on your taxable income. So, you know, that any expenses, deductions, write-offs, whatever you want to call them, it's just going to lower that taxable income that you have for the year. And so, for example, I mean, it's not uncommon to have maybe around 20% of your income in deductions. And so that $100,000 example, we talked about QBI, so there's already 20,000. Maybe you have another 20,000 through mileage deduction, home office expenses, you know, et cetera. So it's just going to lower that taxable income. That taxable income is then going to be inserted into the tax brackets to calculate your tax. So it's a progressive tax scale. So it's going to, with that example that I gave of 60,000, you know, the first, you know, up to a certain amount would be taxed at, you know, it's really 0, and then up to, you know, 12%, 22% from there. So, and then your question about credits. So credits are going to offset actual tax. So credits are definitely more valuable than deductions. So deductions are going to lower your taxable income, which then feed into the brackets to get your tax. Credits are actually going to offset tax. So for instance, I mean, everyone's familiar with the stimulus payments. You know, we use the $600 one, for example. That was a tax credit. So if you owed $1,000, well, you've been credited $600 because of stimulus, and now your tax bill is $400. And there's a whole bunch of different credits that are out there. And so those are always very valuable if you can get them. So R&D credit is a big one for some of my clients that are in the industrial space. So.
Sorry, is that a credit that applies to real estate, the one you just mentioned?
Well, it's possible, but probably really unlikely.
Okay.
And so I would say credits in the real estate space are not as likely. I mean, one of the credits would be, you know, an electrical vehicle credit. So that's one to look at. I'm trying to think of any other credits that come to mind, but I can follow up with you with some examples of credits in the real estate space. But I would say deductions are going to be probably the biggest focus, and gotcha. Then tax structure as well. I mean, those are two big ones.
Okay, thank you.
Yep.
What other questions do you guys have?
I think I have two as a very brand new real estate agent and also a fairly new real estate investor. I think the first one is like, so I'm just getting started out. What can I do to make your job easier when I talk to you next year? And then second one, what are the considerations for someone who is both a real estate agent and a real estate investor? I guess that's it.
Okay. Let me just take those down. Well, okay, let's talk make my job easier. And so I would say first step is to create an LLC for yourself. I would then flow all of your income and deductions, be diligent about using your card for business expenses, and that's just going to create a general ledger for your business. And from there, we can create a financial statement, which is going to be needed to flow into your tax return. So that would make my life, and then also your life, a lot easier come tax time. So that would be just kind of the 101, what I would recommend doing. You're going to need an EIN to do that. So first step is get your LLC through the state, Secretary of State of Washington, and then an EIN through the IRS. And so both are fairly straightforward. A lot of clients will ask if I will do that, and we really don't. The reason being is we're just going to be asking the same information they're going to be asking, and it just didn't really make a lot of sense for us to do that. So I would say start there, get that business bank account opened, and start flowing expenses through there and just staying organized. I would say another good thing to do too would be, I like the Mile IQ app. I'm sure there's other apps to track mileage, but being able to just keep that over the course of the year. And what I also think is motivating about that app is that it actually tells you how much deductions and how much actual tax you're saving. And so that'll kind of keep you doing it. And I don't drive too much for my job, but people in the real estate industry will typically maybe on a Saturday you block 20 minutes to just look at your calendar, code some of those drives that you made over the course of the week, and then see, oh, well, I saved myself $100, and that was a pretty good ROI on tracking there. So that would be another thing to keep in mind. From there, I think you're gonna be in pretty good shape. For the second one, being a real estate investor and a real estate agent, I think is a great combo, because you qualify as being an active as a real estate professional, is how the IRS will state it. And that means that those active losses can offset your active gains on your real estate side. So those losses are really valuable when they are active. A lot of people have, significant passive losses, but maybe they're just carrying them forward through time. And that's where I'll have a conversation with some of my clients. Well, hey, we got to find some passive gains for you. So maybe, stock market is probably the best recommendation for them. But, and in your case, being able to use those losses against active income is just a huge benefit, because you are in the industry. And then I would say same thing on your side of your investment properties. Silo, though, I would say having those in an LLC is very important. Being able to protect yourself from anything that could happen at those properties, and then also being able to keep track of the expenses and everything that's going on your investment side as well. And then finally, just making sure it's just missed way too much is just the depreciation on those investment properties, and making sure it's done properly, because it's just a huge deduction that happens more often than I think a lot of people think. So, and then, so anyway, I'll tap out.
On that note, should you have a separate LLC for each investment property?
I would recommend that. And I think most lawyers would agree with me there, because if something happens at an investment property and someone tries to sue you or litigate, those assets are going to be contained in one spot. So you don't want to open up your personal residence. You don't want to open up your stock portfolio, whatever other assets that you have, just because it's a riskier investment.
And then we have some brand new agents on here. So for them, would you suggest, even being brand new, they start an LLC for their real estate business?
I would recommend that. Yep. I think it's going to start you moving in the right direction. It's $200 a year to do it with the Secretary of State. I think it's a nice little cheap insurance policy to be in an LLC. So I would recommend that. I would hate for someone to be in a sole prop and have the issue of, well, man, I wish I was in an LLC for that little amount. And then that opens up some more flexibility too, if you want to move into a C or an S, and being in an LLC is going to be the first step to do that regardless. And so that's a typical path for a real estate agent. But, someone who wants to, I would say the person, if you don't have a lot of other assets out there that are at risk, then I would say it's less important. And you could stay in a sole prop. I'm sure that's fine. But if you have other activity and other assets out there, I would shield those.
Larissa, did you have a question? I saw you were like leaning into the computer.
So I get asked that question a lot as the check writing person at the office. And I feel like all the agents think they're immediately going to get this huge tax benefit by forming an LLC. And our CPA said that you really don't see any benefits until you're making about $350,000 in GCI. Does that seem accurate?
Well, the taxation of a sole prop and an LLC are exactly the same. So yeah. I don't think that there is even a number that comes up where it's like, oh my goodness, the tax benefit of an LLC is so great, because they're exactly the same. You're getting hit with full self-employment tax, all the way up to your Medicare and Social Security limits. Yeah, they're mirrored. So I think the savings starts to come in when we look at other structures, and most likely as an S structure. A C potentially could make sense, but those are more companies that are going to be retaining earnings and not really distributing out, which not a lot of agents are doing. So the S makes a lot of sense once you pass through, and once you pass over the reasonable wage per year, which is a a calculation that we do with clients. So I agree with you though, Larissa, that yeah, I do think that there's a misconception of people thinking that getting into an LLC is going to be this big tax break, and it's absolutely not. It's more, the
right?
benefit is more legal. Yeah, that's what it's, LLC, limited liability corporation, and so that's, or limited liability company, excuse me. And so that's the benefit of moving over to an LLC, is just, it's purely protection. But on the top or an LLC, we still have all those other tools. We have deductions, we have retirement, we have all those things that we talked about.
One of the questions in the chat is, can we roll our profits from rentals and real estate sales into a whole life insurance policy using tax code 7702A? Would there be benefits to doing that?
Rolling it into a life policy. Oh man. Well, I am not the biggest, I wouldn't say I'm the biggest fan, maybe lack of a better term. I'm not very pro life insurance, permanent and whole life insurance policies just in the first place. And so I say that, I mean, that's a bit of I would have to see the math on rolling it into something like that. And maybe I don't really have a great answer, but if you want to shoot me an email, I'm happy to follow up on that if you want to give me some more details about that policy. But I can't say I've done that before. It would still have to run through a Schedule E. I mean, you're still going to have taxation there, but it would really be the break of moving it into a whole life policy. I can't say I have a good answer for that, so happy to follow up.
Okay.
I have another question. So I'm a new agent, and I've been hearing things about how you should plan to set like somewhere between 20 and 30% of your profits aside to plan for taxes at the end of the year. So my question is, do you think that 20 to 30% is an accurate estimate? And also, I'm wondering how, which portions you should try to set aside. Like if you're a real estate agent and you make 3% commission, and that's like $15,000, but then especially as new ones, we have to like split it with the brokerage and part of it goes to our coach or something like that. Are we paying 20 to 30% on our gross commission, or are we paying 20, 30% on like half of it, the part that we get to keep?
Really good question. So what you're paying tax on is your net profit as a sole proper in LLC. And so to answer your question, it's going to be the bottom line. So if you made $10,000 and you paid somebody $5,000, it's going to be that $5,000 net. That's going to be taxable. It definitely depends on where you're at in the brackets for that percentage question of what to save. But I would say it's going to be on the higher end of where you gave it. Let's say, I keep using like the $100,000 number, but that's about an effective rate of like 14 or 15%. But then we also have to account for that self-employment tax of 15.3%. And so that would take us to 30. As you start making more money, your effective tax rate is going to go up. And so that's something that you just want to plan for over the course of the year. I wish I could give you a better answer than it depends, but it really does depend on how much money you're making. But I would say, 30% sounds right, but it could go up, a lot higher than that. Heck, if you're in a higher bracket, I mean, it could be up to 40, 45% that you're going to want to put aside. And that's 40 would probably be the highest effective rate.
Okay. Got it.
Yep.
Well, thank you.
Anyone else? All right, well, Trent, do you have anything else? Do you want to put your email and phone in the chat?
Oh, yeah. I think I might be able to share the PowerPoint one more time.
Thank you for doing this. This was really helpful.
Oh yeah, happy to. And then if you have any questions that come up, here's my email and phone number. So yeah, happy to talk through it. If anybody's interested in CPA services, feel free to shoot me an email and we'll set a call up. We do free intro calls. Can kind of talk about your unique situation, even outside of real estate, as being a real estate agent, what's going on with, the rest of your family and how we can help at Trail CPA to lower your tax and make your life a little bit easier. So,
And like I said, I vouch for him. He's great. So
thank you, Lena.
if you don't get any of his info written down, you can ping me too, and I can get you his contact info.
Yeah.
Awesome. Well, thanks, Trent.
Oh, thank you so much. Thanks for having me. Thanks for tuning in. And yeah, I'm available. So thanks again.
Thank you. Have a good day, you guys.